Welcome everyone to the second half of our discussion of income inclusions. Here we are we left off with interest income. These are the types of interest income that we're going to look at in more specific. Notice that income for interest on U.S. bonds are included in your federal income tax. So interesting enough, the federal government taxes your income from buying federal bonds. So some specific ways or things that you should consider if interest income. U.S. savings bonds, there is a couple of options. You redeem, report, are going to sold or redeem to report all accrued interest. They can accrue it over time. No one does it that way, though, I will tell you. Basically, you buy a savings bond, your grandma pays $50 for it, and then when it matures, you go in to take it into the bank. She gives it to you, and you take it into the bank, and you get $100 or something like that. That $50 is income, that difference. Treasury bills, generally you're not going to see individuals with that very often, but they have a very similar way. They pay income when they mature. All right. When you buy bonds between interest payment dates, you pay accrued interest. So accrued interest is paid, and you deduct it against the amount that you receive. So you pay interest for the time period that you didn't own the bond, and then when you get paid for the entire period, you get to deduct that amount, and you only include the kind of the difference between what for the whole amount and the time that you didn't own the bond. Now, OID, this your author spent quite a bit more time on than probably is necessary, but you should know what the de minimis rule is. That if there's just too small, OID means you are buy the bond for less than its face value, and then at the end of the term you redeem it for its full face value. So you get a $100,000 face value bond for $95,400. The OID is then the difference between the two, original issue discount. That's minimus because it's less than 7,500. This formula tells us how to calculate the de minimis amount. So you would keep this on, record this in your records that you bought it for $95,400. When you get $100,000 at the end of 30 years, that difference, that $4,600 would be capital gain when you redeem it at the end. If it's not de minimis, then you must have to add it to your income each year. Bond premiums is when you pay more than the purchase price, and that gets either depreciated, if you will, over the life of the bond, or just keep it as part of what you paid. So if you paid $102 and then you sold it and then you redeem it, then you would get a capital loss at maturity. Now this is the one that imputed interest. A lot of times people will loan some money to a friend or someone without interest. The IRS does not believe that. In fact, they have set rules about what interest should be based on short-term, mid-term, long-term, and actually publish these monthly. So imputed interest rules require that interest be compounded at least semi-annually. So basically the idea is we pretend that interest was either paid or accrued. So three places that this may come up: gift loans, compensation loans for employees, and between the corporation shareholders. So gift loan, there's some exceptions. Do not worry about loans that are under $10,000 as long as they're not used to produce income producing property. We don't have to worry about it even up to $100,000 as long as the borrower does not have a lot of investment income. Okay, and if it's between 10 and 100,000, that imputed interest cannot exceed the net investment incomes. So we want to buy a house, $20,000, zero interest, all right, full amount 10 years. This would be over 10,000, so it wouldn't be the first exception, but it could be one of the two other exceptions, as long as the grays, the ones that are borrowing the money, do not have more than $1,000 of net investment income. And if they do, it would only, the imputed interest would only be that amount. It could only be up to that amount. So what happens if there is a gift loan? If it's over the $100,000 and we have to impute interest, what's happened is the situation is that the borrower is pretending to pay interest for the imputed amount based on the rates published by the IRS, and then because it wasn't that, and then the borrower, the lender actually receives interest income, reports it as income. Then it is treated as a gift that the borrower is now gives back to the lender, is deemed to make a gift to the borrower because no money actually changed hands. So that we're not going to worry about gift tax right now. Basically, then what's going to happen is the lender is going to have income, and the borrower is going to have potentially a tax deduction for the interest, even though it wasn't paid. Now, if your employee borrows money, then again, we won't worry about anything under 10,000, and they don't pay interest. Then we figure out what the interest would be. We count it as income to the employer, who then is treated as paying it back to the employee in the way of wages. So what it actually ends up being is a wash for the employer because they have income and expense for the same amount, and it's income to the employee. So what a freebie loan ends up being, if it's over 10,000, is extra income for the interest that should have been charged to the employee. Okay, so here's an example of how much how you calculate the imputed interest, and ABC would have interest income of $1,218, paid wages of $1,218, which washes, okay, the income and expense for the same amount. But Emily ends up with $1,218 of extra income. Same thing happens with corporation and shareholders. $10,000 is the de minimis amount. The amount is assumed to be a dividend to the shareholder. So we figure out how much the interest should have been using the AFR, and then we subtract what was actually paid in this case, because this wasn't a freebie loan, this was just a low interest rate loan. So CAM is deemed to pay $632 to ABC. They report income, pays a dividend, which is not deductible. So this doesn't work out quite as well for the corporation. They have income, and CAM has income as a dividend. So this is kind of the worst case scenario. All interest is reported if it's over $1,500 on Schedule B. You see how that's listed. Okay, dividend income, very similar, not a lot of difference in how this works to interest. Ordinary dividends or any income dividends distributed from a C corporation, they are taxable to the recipient. We'll see more exactly how that is treated on the corporate side in a later chapter. return of capital distributions. These are usually designated on the paperwork the investor gets, and they are not included in income because they are just payback of what the original investment was. Dividend reinvestment plans were popular many years ago and have kind of fallen out of favor. They're very rare, okay, but they are dividends that are taxable. They're usually reinvested in more stock. Dividends are also reported on Schedule B. So Schedule B is interest and dividends. Kiddie Tax. Basically, the idea of the kiddie tax is that if a qualifying child, and you see what constitutes qualifying child. So basically, if they're on their tax return as a qualifying child, dependency, like we talked about back in Chapter 1, there's a little more to it than that, but basically that's the idea. Then if their unearned income is greater than $2,100, then that extra income is taxed at the parent's rate rather than at the kid's rate. So a qualifying child gets $1,050 that they can earn or they can have as unearned income, and it's wiped out by the standard deduction. Then they can have another $1,050 that they pay tax at their rates, and then anything over that is the tax is calculated based on the parent's rate. And that's what these slides basically say. So this calculation, while complicated, basically is the idea that the first $2,200 is half of it's not taxed at all, and half of the child's tax rate. Everything else over that is a higher rate. And this is only unearned income. So interest, dividends, that sort of thing. So anything to do with wages does not trigger this. All right? In fact, the regular standard deduction applies to the wages part, and in this case, the extra $350, like we learned about standard deductions way back in Chapter 1. Okay, so this is how you calculate that. So if you just look at this, wages is not going to be covered by the standard deduction, $350. Okay, above that, then she gets the rest of the unearned income. Okay, $4,300 minus the $1,050 for standard deduction, minus the $1,050 at her own rate, and then the rest is at the 35% or the parent's rate. So in this case, because she doesn't get that full $1,000, she pays on the $1,750, which is $2,200 minus the $350 above the earned income. So another add-on tax that was put in the tax law a few years ago is the net investment tax. This qualifies on dividends, gains on the sale of property, annuities, that sort of thing, rents. So you first of all take out regular expenses for that type of income, and if it goes, your AGI is over these thresholds, then you pay 3.8% of the amount by which you exceed it, or the amount of your net investment income. So a couple of examples. All right. The difference is 70. They're over the threshold by 70,000. They have 50,000 net investment income. They pay 3.8% of the 50,000. And they're over the threshold 27,000. They have 30,000 net investment, so they pay 3.8% of the 27,000, the lower of the two. And a third example as well. Tax benefit rule: if you got a deduction in 1 year and get a refund of that in the following year, it is income. If you did not benefit from it in the year previous, then when you get a refund, it doesn't matter. It's not income. So example here that usually comes up is the state taxes. You only get a benefit if you itemized. Remember, you choose either itemized or standard. If you use a standard deduction, then when you get a tax refund from the state, it is not taxable because you got no benefit. A little bit about illegal income, and you actually can take deductions. That's kind of an issue in certain states about with the marijuana growing because federal law still says that that's illegal. And then gambling winnings are included in gross income, but you only use gambling losses as an itemized deduction. So if you use a standard deduction, you get no benefit from gambling losses. It is not a direct deduction against your winnings. So gambling winnings are not tax favored. That is not a good form of income under the tax law.